Well, good afternoon, everyone. This is Rob Odell from Naples, Florida, and I want to welcome you to Wheaton Wealth Partners Last Minute Tax Planning Workshop webinar for 2014, What You Need to Do Now. We are excited to have this webinar today. It will last 1 hour, and I'm going to go right to the introduction of Brian Eisenmenger. Brian Eisenmenger founded Eisenmenger & Company CPAs in 2001. Brian has extensive experience in tax preparation services and financial consulting, including trust, business planning, management services. He's worked with successful small business owners, corporate executives, and retirees. Brian earned a bachelor's of science degree from Eastern Illinois University and has a master's in taxation from Northern Illinois. He holds a certified in public accounting from the states of Illinois and Texas. In addition to his practice, Brian is a frequent speaker on tax and accounting topics throughout the United States for Thomson Reuters. Now, before I turn over to Brian, Brian is very happy today because he's also a die-hard fan of the 13-time world champion Green Bay Packers. Had to get it in there. So with that, Brian, I want to thank you for being a part of today's workshop, and I'm going to mute you in just a second here.
Good afternoon, everyone. Welcome to our webinar, and it is very good to be here. I don't know if you noticed, Rob, I don't know if you can see from here, but I don't know if you can see this tie. This is a very special tie. I'm trusting you're wearing one just like it. It is a Green Bay Packer bow tie for Bow Tie Tuesday. So I don't know if you got the memo that you're supposed to wear that today.
I'm going to buy one right away.
Okay, see, I knew you would. But anyways, welcome everyone to our webinar, and there's a few things we wanted to talk about today. The first one is one of my favorite quotes. I know this is not a Vince Lombardi quote, and that really bothered Rob, but this is a quote by John Wooden, and it's obviously the great coach of the UCLA Bruins, but he said, "Failure to prepare is preparing to fail." And so what we're doing here today is giving you some last-minute advice that you can take and hopefully implement before the 31st of December, before D-Day for your 2014 taxes. So with that, what you're going to see here on the screen is you see the tax rates. And what I want to point out to you is that when you have that you're in the 15% tax bracket, take a look at that with the long-term capital gains and qualified dividends tax rate. Those are 0%. So that is an opportunity, if you are in a lower tax bracket, to take advantage of some gains on stock investments and not be taxed on it. Then you'll see we go from the 25 through 35% tax brackets. Then you have that capital gains are taxed at 15%. And then if you are at the highest tax bracket, the 39.6% tax bracket, your capital gains get taxed at 20%. Now there's another tax bracket that's not included in here, and that's called the net investment income tax bracket. And what that is, that's an additional 3.8% tax. We'll be talking about that later on, but that's going to be on long-term capital gains and short-term capital gains and qualified dividends as well. And that's going to be for people if they're single or head of household who make more than $200,000, or if they're married filing joint, they make more than $250,000. The other thing I want to point out on this screen is that take a look. There's something that we call the marriage penalty, and you'll see in terms of the higher the tax bracket, when you go and you are in the 33% tax bracket, actually even starts much lower than that, really in the 28% tax bracket, you start seeing that you're better off to be single than filing a married filing joint return if you've got equal income. So once again, just something to point out to you that the marriage penalty for higher income earners is alive and well, which brings me to one of my favorite quotes that comes up here, that every culture has some ritual for joining two people together and making them stay that way, and ours is giving them tax breaks. Well, that's true if they are in a lower income tax bracket, as we can see here, but it's not so true if they're in a higher income tax bracket, which brings us to our next quote that says, "The way taxes are, you might as well marry for love." So keep that in mind if you are engaged in doing your tax planning for this next year. So again, what we'd encourage you to do is that if you are in some of these lower income tax brackets, we would encourage you to take advantage of that 0% capital gains tax. I mean, that means you've held stock, maybe it's Apple stock, maybe it's Campbell's Soup stock, who knows what stock it is, but that's potentially gives you that you don't have to pay any type of income tax on that if you are in a low enough income tax bracket. The other thing that we would encourage you to do is that, and in fact now in terms of this time of year, you should be able to see whether you're going to have a lot of capital gains. If you do have significant capital gains, then the other thing we would encourage you to do is to sell your losers, and that is take advantage and sell some stock that you feel has not performed well. And then we would encourage you to pick it up again after 30 days. So you might say, well, why pick it up again after 30 days? And we'll get to that in just a moment. But what we want to do here, and what this next slide shows, is that we want to do what's called tax bracket arbitrage. And what you want to do in this situation is that if you're in the 28% tax bracket or higher, well, in that situation, we want to avoid taxes, defer income there as much as possible. And then if you're in a lower income tax bracket, like the 25, 15, or 10%, well, those are the situations that we want to take advantage and actually bite the bullet and pay the taxes at those rates rather than pay them at much higher rates. So again, we want to avoid the higher the income tax, higher income that you have, the more we want to avoid, and the lower your income, the more we want to accelerate your income and pay tax now. Now, that doesn't come into play just for capital gains and losses. That also comes into play for someone who's maybe considering doing some type of Roth conversion, where they convert a portion of their IRA to a Roth IRA. Perhaps they can do that and remain in the 10 or 15% tax bracket, and by doing that, they're paying a lower tax now in exchange for paying no tax in the future.
Brian, if I could interject, if I could just ask a question.
Sure, go ahead.
Part of long-term capital gains is qualified dividends considered tax-free for those in the 15% bracket? Meaning, what is the taxation of qualified dividend income?
Well, let's go back here to this, and I'm going to go back here to the one, what we have there. So that means that this slide shows it. So if you're in the 15% tax bracket, you are going to be taxed at 0%. On long-term the long-term capital gains and also on qualified dividends.
Yeah, so you're saying that long-term capital gains are taxed like, qualified dividends are taxed like long-term capital gains, according to this chart here.
Correct. Okay. Correct. So yeah. So again, we want them to have it taxed, and again, this is part of the tax laws that were made permanent this time last year. So yeah, that's where we're at on capital gains and whatnot. Let's see. That brings us though to the situation of wash sales, and I do want to bring this up because when you do sell a loser, you want to be careful when you want to be careful that you don't pick up that stock again too early. Maybe it's again a stock you're selling it, it's a loser, but you really still want to own that stock because you believe in it. So what happens is you have a wash sale that could discount that would make your loss that you were taking, it would make that not deductible. And what a wash sale is that occurs if you sell a stock at a loss, and then within 30 days before or after the sale, you buy that same stock. So let's suppose you bought Apple stock and you sold it at a loss, and then 15 days later, you said, gosh, I really wished I wouldn't have sold it. I'm gonna pick it up again. Well, if that's the case, then you've just lost that loss. So you want to hold off purchasing that stock for 30 days. So again, if you do have a loss from a wash sale, that makes it so that the loss is not deductible. So keep that in mind if you are selling some losers. Now, the next thing I want to talk about is Obamacare. The reason I bring up Obamacare is I don't know how many people on this phone call are going to be, how affected they are by Obamacare and by the credits that they're going to have. But there is a concern that I have that people are going to be snuck up and they're going to have to pay some taxes if they're not careful. So Obamacare is based on, and the credits that a person receives is based on where they fall within the federal poverty level. And you take a look at this, and boy, I bet you didn't realize that a family of 6 that makes $127,000, that's 400% of the federal poverty level, and suddenly they are someone who qualifies as getting credits. And if they're not careful, they might have to square up and pay some tax at the end of the year. So again, this is a chart that shows the federal poverty levels for various people and where their income is at. So what happens here is that you get a credit, a premium assistant credit, that you can either have applied right towards your premium. So you basically have it that the government pays the insurance company, or you can have it that you receive all that credit at the end of the year. Well, most people are opting to have that credit applied right towards the insurance company, because if I don't have to come up with all the money, let's say my insurance policy is costing me $1,000 a month, and with Obamacare I only have to pay $600 a month. Well, why would I want to pay the $1,000? I'll just have that $400 credit, have the government take care of it, and have it go straight to the insurance company. So what happens here is this is how the initial premium assistant credit, how it's calculated based on where a family falls within that federal poverty line. So the credit is going to be based on the lesser of the actual premium paid, or the benchmark premium less the household income times the applicable percentage. Boy, this is going to be some calculating that takes place here. So what is that benchmark premium? Well, that benchmark premium is the second lowest silver plan offering applicable coverage for that individual at the time the taxpayer or the family member enrolls in the qualified health plan with the state marketplace where the individual resides. Now, take that and check that out. That says state marketplace. Remember, not every state chose to be part of the state marketplace, and those situations now are before the Supreme Court, and how the Supreme Court's going to decide it here, I think in the next few months. But that's how the law is written. So you take the benchmark of the second lowest silver plan in your state, and you compare that to the actual premiums paid, and you get a credit based on the lesser of those two. So let's take a look at this and how this applies in the real world. And rather than go through all the calculations, this is how it would apply. Is you've got Rob. So Rob is a single individual. He lives in Illinois, and he has a household income of just shy of $30,000. It's $29,175. The second lowest silver plan in Illinois costs $4,500 per year, or to say it another way, it costs $375 per month. So Rob's income is going to be 250% of the federal poverty line. That's what it is. So his applicable percentage is going to be 8.05%, and his contribution is expected to be $2,348, or to put it another way, $195 a month. So Rob is going to get premium assistance credit for the year of $2,151.41. So what he's going to do, if he's like most people, he's going to have that premium assistance credit. He's not going to get that at the end of the year. He's going to take and say, hey, I just want to pay $195 a month rather than the $375 a month. I want to pay that to the insurance company, and I'll square up with the government at the end of the year in terms of how that works. So if he chose to have the premium the premium assistance credit paid directly to the insurer, he's going to have to square up, which may not sound like a big deal, but here's the thing. What happens if Rob's income is now more than $29,175? Well, if that's the case, depending on his situation, he's going to have to pay back a portion or maybe all of his premium credit. Now, that's if his income increased. What happens if there could be other situations that occur here too, that perhaps Rob has a change in dependents, or Rob gets married, or there's a change in his situation as filing status. That too could have an effect. But the sad part is, and what I see here, and this is what I've said to Rob and I've said to many people, just wait till Fox News gets a hold of this. And that is, this square up is not going to occur until February, March, April of 2015. And when this happens, people are not going to expect it. And when they have to square up and all of a sudden they realize, gee, I made more than what I thought I was going to make, and suddenly I owe a couple $1,000s to the government, where are those people going to get that money from? So here's an example, another example, and here's Heather. Heather's a single taxpayer. She has 2013 income of $27,900, and it's used to calculate her advance payment to her insurance company of $3,500. Well, things happened during 2014 that was not considered when she made that decision. First of all, she left her employer and she receives a 401k distribution of $18,780. And she takes that money from her 401k and she says, I'm going to take that money and I'm going to use it to pay down my credit card debt. Well, then when she looks at her salary for 2014, she gets another job, and now she makes $28,000. So between that and her household and the 401k distribution, she now makes $47,000, and she's now over that 400% of the federal poverty line. So not only is Heather going to be subject to the income tax and pay the penalty on the distribution, but she now has to repay the entire advance payment. Remember what that was, $3,500. She has to pay that because her household income is no longer less than 400% of the federal poverty line. And the question is, think about this. Not only is she going to have to pay income tax, she's going to have to pay penalty on that 401k, which is going to be 10%, so that's another $1,800, $1,900, plus she has to pay back the $3,500. And the question that I have, and the question that the news media is going to have come February, March, and April is, where is she going to find this money from? Where is she going to find this $5,000 that we're talking about? Where is she going to get that money from? Because it's not like, in this situation, this person's made of money. So that brings us to another quote, that being in love is like being lit on fire and having your loved one morphed into a marshmallow as she runs to embrace you. But not feeling in love feels so much worse, possibly like a tax collector. Well, actually, nothing compares to the lowliness of a tax collector. So just another quote there. So that now brings us to another issue. And again, this next issue isn't so much tax planning. This is just the hot area that people are talking about. It's actually an IRS concern, and that's phishing and ID theft that's happening with the IRS. One of the things that happens is, and I imagine that if we did a poll of everybody on this call, it'd be interesting to know how many of you have received an email from the IRS or received what you may have thought was an email from the IRS. Well, first of all, the IRS does not use email to communicate with taxpayers. So if you received an email from the IRS, beware. It didn't come from the IRS. That's someone who's trying to put a scam on you. So what you want to do is, if you receive one of those emails, you want to contact TIGTA. And TIGTA stands for Treasury Inspector General for Tax Administration. And what you want to do is you want to go to their website, and they have a scam alert, and they have a form that you can complete. Then you can also forward the scam emails to this email address that you see right there, phishing@irs.gov. What you do not want to do is open up this email or any attachments or any links in those emails. This is a scam. They're trying to attack you and trying to get information from you, and obviously information from your computer. So again, the IRS does not use email to communicate with taxpayers. But along with that, what if you were to get a phone call from someone who claims to be with the IRS, and they say, hi, I'm with the IRS, and we have down that you owe $15,000. In fact, this just happened to a client of mine recently, where they got a phone call from someone who said they were with the IRS and that they owed the IRS $15,000. And the client calls me up and says, hey, I thought we were all square on our taxes. And I said, you were all square on your taxes. What do you do in this situation? Well, this is someone who is looking to scam someone, and they pose as being the IRS, and they say, we're going to be over at your house within the next 30 minutes, and we expect a check from you at that time. Well, first of all, if you think that you might owe taxes, or you wonder what's going on here, first thing you want to do is hang up and call the IRS at the 800 number that I've got listed on there. It's 800-829-1040. And in that situation, the IRS will help you with your payment questions. Now, if you don't owe taxes, and you're very sure you don't owe taxes, you can call and report this incident to TIGTA at the 800 number that's there. It's 800-366-4484. And what you can also do is file a complaint with the Federal Trade Commission at ftc.gov, and you can then add the IRS telephone scam to your comments in your complaint. But again, you can report these to the IRS, and there's a lot of bad people out there trying to get information, trying to get your information from you. But the other thing that happens, and probably the biggest issue facing the IRS, is the ID theft and refund fraud. And what happens in that situation, this is where someone is filing a tax return on your behalf, and they go and they claim credits. They might be claiming college credits. They might be claiming things like the earned income credit, child credits, and they're trying to do this and basically defraud you, the taxpayer. And if you feel like you've been subject to any type of ID theft, and then in that case what you want to do is there's a form that you file, Form 14039, and what you can do is you can file that form with the IRS and then fax it in or mail it in, and that way you're not. Now, what's one of the ways that you can tell if you've been subject to ID theft or any type of fraud? Well, common indicators of ID theft for tax purposes is, first of all, if you go to electronically file your tax return and it gets rejected, and it's rejected by the IRS because one of the Social Security numbers has already been used, that is an indication that there's been some ID theft. Also, if you've had more than one tax return that's been filed under the taxpayer's Social Security number, that would be an indicator of identity theft. If there's a balance due or refund offset or some type of collection action has been taken against a taxpayer and there's been no tax return that was filed for that tax year, well, that's obviously, we haven't filed a tax return. How am I supposed to get how is there supposed to be a balance due, or how is there supposed to be some type of refund offset? If the IRS records indicate wages are recorded against a person's account and the taxpayer has no indication of who the employer is, then that again is a indicator of ID theft. And then as well, if there's been phone contact that's been made to the taxpayer with the individual on the phone aware of a significant amount of their personal information, again, that's an indicator of ID theft. And again, this has been a very hot topic, with the IRS. And my guess is if we were to take a poll here of people on the phone, my guess is that there's someone here who's probably been subject to some type of ID theft involving the IRS. There's refunds out there that unscrupulous people are trying to get, and they're trying to get them before you file your tax return. So that brings us to our next quote, and that was, he was just getting to the point where he didn't understand why tax attorneys didn't just kill themselves, and that's from Orson Scott Card in the first meeting in the Ender's Universe. So that brings us to the next subject, and this is qualifying longevity annuity contracts. This is something that's brand spanking new for you that you are going to be allowed to take advantage of, not only in 2014, but this is something that you'll be able to take advantage of if you so desire going off into the future. And what it is earlier this year, the United States Treasury, they issued a Treasury decision, and they allowed participants in IRAs, 401ks, 403bs, and 457 plans to enter into what are called qualifying longevity annuity contracts. And what this is this is a type of deferred income annuity. So what happens in these types of contracts is that they are allowed to invest the lesser of 25% of their account balance at the time of purchase, or $125,000, whatever's lesser, into some type of annuity contract that begins at an advanced age and will not count towards the participant's required minimum distribution balance. So this means that if you have that you're taking required minimum distributions from your IRAs, 401ks, 403b plans, you're taking these and you're going, you know, I don't really need all of this money. Well, then, by having one of these qualifying longevity annuity contracts, this would reduce the amount of your minimum distribution. So the way that these work is that the owner of the retirement account no longer is required to include the value of this type of annuity in the value of their IRA, 401k, or 403b plan. So they don't have to include this when they're computing their required minimum distribution. So what this does is this is going to allow the owner to defer payments from the qualifying annuity up until their age 85. So think about this. You're age 70, you can put $125,000 away that you don't have to start taking payments on until you're age 85. That allows 15 years of extra tax deferral. And again, if you are in one of those higher tax brackets, again, we like the idea of pushing taxes out towards the future. So benefits are going to be allowed to be paid after the death of the participant to their beneficiary. And then at the death of the owner, a plan with a qualifying longevity annuity contract, what they can do is they can protect their investment by providing an option that allows for a lump sum payout of any unused premium. And then there's a contract purchased by a retirement plan that must specify that is the intention of the annuity to qualify as a qualifying long-term annuity contract. So you need to make sure that that the contract itself qualifies for this type of annuity. So let's take a look at how this works in terms of an example. Here we've got John, and John is age 70. He has a balance of $650,000 in his IRA. And so what John does is he purchases a qualifying long-term annuity contract, longevity annuity contract, in the amount of $125,000. That's the most he can put in. And what he does is this reduces the balance that's required for his required minimum distribution. It reduces that to $525,000. So by doing this, this reduces his required minimum distribution for 2015 by over $4,500. So it's not just for 2015, but this is going to be for 2016, 17, 18, all the way until he's age 85. So if John has chosen to defer a payment from his QLAC contract until age 85, he now has allowed his retirement assets to grow by approximately $50,000, and he's deferred taxation of over $70,000, providing additional funds for either late life expense or his heirs. So again, this is something, again, that might be a very good deal for people who do not need to take they take a look at their required minimum distribution from their IRA and they go, I don't need all of this money. Having one of these types of annuity contracts might be a solution for someone like that.
Brian, we had a question.
Poundstone said the wages of... Yeah, go ahead.
Quick question came in. Do qualified lifetime annuity contracts, do all insurance companies issue them? Is it a specialty contract? You need to seek certain insurance companies, not to put you on a spot to give a plug for one company over another, but where would someone go to purchase one of these contracts?
Well, you'd want to go to an insurance company, and I don't have a plug on these. Again, this is new. This is new in 2014. So I don't know that many people are even aware that this thing is out there yet. I don't know if you've seen it talked much about, Rob, first of all?
I have not. I'm just starting to hear things about these contracts coming out. I've not even seen an insurance illustration or promotional materials on these contracts yet, at least on my side. But I'm sure it will. It's only a matter of time. The insurance industry is there's a very good industry in getting this type of communication out. Very creative industry.
Yeah. So, I mean, I don't have a recommendation on a company or anything. I don't even know what companies are out there that have offered it yet, but I can tell you that my guess is if any insurance company that offers annuities are probably looking at offering some type of product like this. And, the beauty to the insurance company is, for them, is it's a $125,000 contract. Yeah, they're up to $125,000. It might be less. So they take a look at this and they go, there's no special requirements on this other than as the annuitant, I don't want this paid out until I'm age 85. And so the insurance company really, they just have to have it out there, and you have to specify, like in your IRA, that hey, you specify that this is a qualifying longevity annuity contract. That's really the only requirement that I've seen out there on this. So that's a great question, but they're out there, and it will become I think a very popular thing for people to utilize here in the next few years. That brings us to something that's new this year on IRA rollovers. In previous years, the courts have allowed taxpayers to roll over numerous IRAs, almost as much as they'd like. However, this year the courts have ruled that a taxpayer has only a single opportunity per year to complete an IRA rollover, not per account as was previously interpreted by the IRS. So the IRS is going to allow multiple rollovers until December 31st, 2014, but then after that, it's only going to be once per year. So a taxpayer, they can make rollovers from multiple accounts, but they're going to be required to redeposit all of the amounts within a single 60-day period. And if the taxpayer takes a distribution from the first rollover deposit of the year, there's not going to be any type of opportunity to complete another rollover, and their subsequent distribution would be taxable. So be careful, be very careful starting January 1st, 2015 on IRA rollovers. Now, this does not apply to trustee-to-trustee transfers. So you can still do an IRA transfer from one trustee. Let's say the IRA is trustee at Bank XYZ, and you want to roll it to Bank ABC, and it's just a trustee-to-trustee transfer. You're going to be okay. But in terms of rollovers, it's only going to be allowed once per year. So keep that in mind. Then Albert Einstein said, "This is a question too difficult for a mathematician. It should be asked of a philosopher." And this is what he responded to when he was asked about completing his income tax form. Let's see. That brings us now to the topic of the net investment income tax. Now, this net investment income tax is something that started last year. It is part of the Obamacare taxation, and what it is it applies when a person's modified adjusted gross income, when it exceeds $200,000 for someone who's single or head of household, $250,000 for married filing joint, and $125,000 for taxpayers when they're married filing separate. Now, one of the things is that the thresholds are not adjusted for inflation. And that always frightens me a little bit, because $200,000, $250,000 might seem like a lot of money today, but I wonder what it will look like in 10 or 15 years if we'll all of a sudden think this. So,
Brian, can you distinguish between adjusted gross income, which is on the bottom right of your 1040 you file every year, and modified adjusted gross income?
Well, what modified adjusted gross income is, that's where they take away they either take away or add in certain items to come up with this number. So, for example, and we'll get into some examples of what's included in the income here in just a moment, in terms of what's included in net investment income, for example. but it's kind of a side calculation is what you call it. But again, this tax then is going to be 3.8% of the net investment income that's going to be above that threshold. So if someone is married filing joint and they make $275,000 and some of that money comes from investments, then 3.8% of that is going to be subject to tax. And here's an example that we'll see here. Here we've got Matt and Joanne. They're married, and for 2014 they've got modified adjusted gross income of $275,000. So that $275,000, $50,000 of it comes from net investment income. So when they go ahead and do this calculation, we're going to take $275,000 minus $250,000 and multiply it by 3.8%, and that's that net investment income tax that they're going to have to pay. That's going to be $950. So it's not going to be based on the full $50,000. It's just based on their income above the $250,000. So if we were to assume the same facts, except that their modified adjusted gross income is $375,000, well, in that case, they're going to owe a net investment income tax of $1,900 because, again, that investment income is $50,000. So it's going to be $50,000 times 3.8%. So, again, this is where they're going to be subject to the net investment income tax in their situation. Again, their wages, their income from earnings is not subject to net investment income, but their investments are.
Brian, we have another question.
Sure.
In terms of municipal tax-exempt income, is that added back into modified from adjusted gross income, or is it not?
It is not. In fact, that's one of the things you'll see on this next slide here is here's what's included in the net investment income. It's going to be gross income from taxable interest. So tax-free interest from municipal bonds, that is not going to be included. That is excluded. Income from ordinary dividends, that is going to be included in this. Gross income from annuities, and that's from non-qualified plans, that's included in that investment income. If you've got income from rents and royalties, or for perhaps businesses that you're not really involved with, those would be passive businesses, that's included. Capital gains, those are included. So remember the capital gains rate, we said was 15%. Potentially your capital gains rate could be actually 18.8%, or if you're in the highest tax bracket, it could be 23.8% when you add this net investment income tax on there. Also, a child's interest in dividends and capital gains that are not, if you have children who are subject to the kiddie tax, those would be subject to the net investment income tax. So all of those things are reported there and are included in this calculation of net investment income. So but there are deductions that you can take. You can take investment interest expense. You can take state and local taxes using any reasonable method. You can take investment expenses, deductions that are allocable to gross income from your rentals and your other business activity, penalties on the early withdrawal of savings, and then as well any tax preparation fees that you can make allocable to the investment income. So those are some deductions that you can take against the net investment income tax. So, and as Chris Rock likes to say, you don't pay taxes, they take taxes. All right, so that brings us to the restatement of some major tax provisions. One of the things is that since the election back on, November 2nd or November 4th, we've been waiting to see what's going to happen in terms of any tax items that were popular before, whether those would come back. And what we found is that so far, as of today, the taxes remain the same. Nothing has changed. In fact, things that we were hoping would be extended are still out there, sitting on the vine, and we wonder, are they going to take hold yet before December 31st? Well, one of the things is that according to Kiplinger's, and Kiplinger's has a pretty good beat on what goes on in Washington, what they are saying is that 2014's tax rules have still not yet been finalized. So You need to know that. Even though today is, December 9th, and the government has 22 days yet, they still have not finalized 2014's tax rules. And what that means for us is a few things. One, it means that our filing season, because the IRS is going to have to get up to speed with forms and whatnot, is probably going to be delayed as it has been for the past few years. But there are some extenders that we're hoping will be extended that are not right now part of 2014's tax rules. And one is the state sales tax that's in lieu of the state income tax. So if you bought a car in 2014, we're hoping, and according to Kiplinger, they're saying a pretty good chance that will be extended. The other one is if you're a school teacher and you spend $250 in the classroom for classroom supplies, that one would hopefully get extended. This next one is probably the biggest one, because this next one was such a good deal for so many people, and that is the direct payouts of $100,000 or less from IRAs to a charity for people who are 70 and a half and older. And this was extremely attractive because what would happen is, think about it before. If you took money out of your IRA and you donated that money to a charity, that had the potential to really throw off a lot of your other deductions. Because what it would do is it would raise your adjusted gross income, and yes, you would be able to take a deduction for your charity, but by raising your adjusted gross income, it would cause your Social Security to be taxed. It would cause perhaps your medical expenses that all of a sudden you couldn't take as much of those. It really played havoc with a lot of other calculations that go into a tax form. And so what the government allowed for the past few years, but has not yet extended yet for this year, was to say, hey, that charitable deduction that you're making, go ahead, go straight from your IRA, go straight to your church, go straight to your charity of choice, and go straight there, and we're not going to include that in your income. Now, you don't get a deduction per se either, but you do get a deduction because you're taking money out of your IRA and you're not having to pay tax on it, and it's going straight to the charity. So
Brian,
hopefully, and this is,
if I could just jump in on that, on the charitable IRA rollover, as it's known as, it is my understanding it has passed the House, looking to go to the Senate, and then signed by the President. They think it's going to be done this year. And I also heard something, it's not an extension, whether they're trying to make that provision permanent, so we don't every year have to have this webinar and talk about the possible extension of this.
Well, what will I do then on December, Rob, if we don't have this webinar?
I don't know. We won't be bored. But a couple of things that we're telling clients, and several of them are on the web call right now, so hopefully this is a reminder, is that if they're going to give from their IRA, they're over 70 and a half, they're going to give from their IRA. We don't know if it's going to happen for 2014, although we're cautiously optimistic, is go ahead right now, it's December 9th, write the checks directly from your IRA to a charitable organization, not a family foundation, not a donor-advised fund, but an end charitable organization now. And if history repeats itself like in 2012, they will honor those checks. But you want to make sure the check clears by December 31st. Now, if you remember in 2012, they allowed you to give up to January 31st the checks to clear of 2013 for required minimum distributions for 2012. So hopefully history repeats itself with a little extra grace from the IRS on this provision.
My guess is they would. My guess is that they would. They don't like to reinvent the wheel. So, but yeah, and hopefully this will. The other one, and this has been for business owners a big thing, but that is bonus depreciation, 50% bonus depreciation, and also perhaps, and what's not on here, but also increasing what's called Section 179 depreciation, which allows companies to write off equipment much faster than they normally could. And hopefully that will be extended, and again, hopefully it will be made permanent. So these are reinstatements that, again, Kiplinger's, and Rob's read some different things in different places. Sources are saying that most likely these are going to happen. Unfortunately, they just haven't happened yet. And unfortunately, it's just the way our government works. Here it is December 9th, and they haven't figured out. So with that, I always like to use this one, this saying, and that is, using coercion to drive charity is like using kidnapping to create love. But I guess if that's what we can do to create charitable by donating straight from an IRA, that's a good thing.
I tell you, the one nice thing for those of you or those listeners, viewers in Texas, Tennessee, and Florida is allowing to have that state sales tax deduction, because those are states, 3 of the states we have callers on or viewers on that do not have a state income tax, and that has a big impact on their income taxes.
That's right. In fact, that's why that came about, is because if you recall, that came about when a certain president from Texas came into office and said, hey, this isn't fair, that other states can deduct their income tax, and yet the states without an income tax don't have anything that they can deduct, but yet they're typically paying higher sales taxes in those states. Unless, of course, you live in Illinois, where there you get to pay both higher income taxes and higher sales tax. You get the best of both worlds.
You get the best of both. That's true. That is true. It's amazing when we do workshops down here in Naples, Florida, and having many people coming from the tax states up north, and they're coming down here in groves, and it's no longer known as Heaven's Waiting Room, unless it's an extended plan there, because these people are in their 50s, early 60s, coming down here, and the tax savings is quite high, and so the northern states are losing revenue, and Florida is growing, as is Texas and Tennessee, are just several of the states that I know they're growing quite well. I would like to make a couple other announcements here. If you are listening today and you'd like a copy of the slides, we can make them available. If you have questions, you can email us. Come up after this webinar, feel free to do that. We'd love to help you, but really the time to plan your taxes is not in April or March the year following. The time to plan your taxes is in October, November, the year before, because once we hit December 31st, it's, as the old saying goes, water on the bridge.
Absolutely. I couldn't agree with you more, Rob. Well, thank you so much for this opportunity, Rob, and I would say if folks have any questions or for me or anything that they want to, feel free to provide them my contact information. I'd be happy to help them out in any way.
Brian, we truly appreciate it. We did it last year, and you were very well received. And by the looks of the amount of attendees we have, they were anticipating this call, so we really appreciate your time and the effort you put forward in putting this presentation together. And for those of you listening today, look for 2015. We'll be doing future webinars, and we'll be posting that and sending out information on those webinars as we move into 2015. So have a wonderful rest of the day. This is Rob from Naples, Florida, Wheaton Wealth Partners.